So, you're thinking of starting a business in Malaysia with a partner? That's awesome. It's such an exciting time. But let's be real. Once the initial buzz wears off, have you really thought about the tax side of things? Well, that's what we're here for, to cut through all that confusing jargon and give you a simple, clear guide on how partnership tax works. Okay, let's jump right in.
You've got the killer idea, the perfect partner, you're ready to take on the world, right? But hang on, what about the taxes? Yeah, I know, it's that one thing that's super easy to just push to the side. But honestly, getting this right from the very beginning, it's going to save you a ton of headaches later on. Trust me.
All right, so first things first, what even is a partnership in the eyes of the law? Because, and this is important, it's often a lot more than just a friendly handshake agreement. The tax office has a very specific definition, and you absolutely need to know what it is.
Okay, the key phrase you really need to zero in on here is with a view of profit. That's the secret sauce. What it means is, if you and a friend are working on something together and the main goal is to make money, well, you could legally be in a partnership without even having a formal agreement. You could be in one right now and not even know it.
And folks, this is where you really need to pay attention. A partnership can exist without a single piece of paper being signed. Now look at that second point, jointly and severally liable. That's just a fancy legal way of saying that if your business racks up debt, a creditor can come after any one of you for the entire amount, not just your share, the whole thing. It's a huge risk, and it's why having a formal partnership agreement is so important.
That massive personal risk we just talked about, it's directly tied to how partnerships are taxed. So let's get to the single most important takeaway from this whole guide, the big question: who actually pays the tax? This is the golden rule, the one concept that trips up so many people.
And here it is, the one thing you have to remember. The partnership, as a business, it doesn't actually pay any income tax. Nope. All the tax responsibility flows through the business and lands directly on the individual partners. The business isn't taxed. You are.
The absolute best way to get your head around this is the pizza analogy. Imagine your business bakes this amazing pizza, right? That's all your profit. Now, the tax office, they don't really care about the whole pizza. They just want to know one thing. How big is your slice? Because that slice of profit is what you will personally be taxed on.
Okay, so how do we actually calculate the size of your taxable slice? Now this part can look a bit, well, complicated at first glance. But I promise, when you break it down, it's really just a three-step process. So let's walk through it together.
All right, let's do this. Step 1, you just start with your normal net profit. Easy enough. Then, for tax purposes, you have to add back any expenses that you can't deduct. And here's the key. You also add back any salary or interest you paid out to partners. You might be asking, why? Well, as far as the tax office is concerned, a salary to a partner is just you taking your profit a bit early. After one last adjustment, you get your divisible income. And that, my friends, is the total pizza that's about to be shared.
So, just to make sure we've got these two terms down, the divisible income is the whole pizza, the total profit that gets split between all of you based on your agreement. But your personal adjusted income, and this is the number that matters for your tax return, is your slice of that pizza plus any salary or interest you already took out. That's the final figure you'll be taxed on.
Right. But business isn't always sunny days and huge profits, is it? What happens when things go the other way? What if there's a loss? And what about tax relief from buying business assets? How does all that stuff get handled?
Well, the good news is the logic is exactly the same, just in reverse. A business loss is also divided up and passed directly to you, the partner. And here's the cool part. You can take your share of that loss and use it to knock down your taxable income from other places. Same thing with capital allowances. That's just tax relief for buying things like computers or machinery. Those benefits are also passed through for you to use on your personal tax return.
And get this, the good news doesn't stop there. You don't even have to use these losses or allowances in the same year. If you can't use them all up now, you can carry them forward to reduce your tax bill in the future. It's a really powerful tool for your long-term tax planning.
You know, businesses evolve. Partnerships are living, breathing things. People come, people go, and these changes can have a massive effect on everyone's tax situation. So let's quickly cover what happens when your partnership structure changes.
Anytime a new partner joins or someone retires or leaves, you basically have to redraw the whole map. The profit-sharing ratios, the way allowances are split, everything gets recalculated from that day forward. And in the very sad event that a partner passes away, there are very specific and important rules that have to be followed. Knowing how to handle these moments is absolutely critical.
So, there you have it. The golden rule is that everything, profits, losses, tax reliefs, and yes, the risks, it all flows through the business directly to you. A partnership gives you incredible flexibility, for sure, but it also demands a huge amount of trust and clear communication. So now that you've seen how it all works, the big question is this really the right path for you and your business?